Hello and welcome to another tutorial video. This time around, we're going to be discussing one component of valuations that is very important called the risk-free rate. And I'm going to be discussing why the name is a little bit deceptive and why the government bonds that you typically use to determine the risk-free rate are not in themselves actually risk-free. So the starting point for this discussion is that a few days ago, I was chatting with a friend about the financial markets and what has happened over the past year or two. And he asked a very good question, which was, I don't understand how investors lost money on US Treasuries last year. Aren't they supposed to be risk-free? They're just government bonds. So what happened? How could they possibly lost money here? And if you look at a chart of some funds that invest in long-term US Treasuries, especially like VUSTX here, the Vanguard Long-Term Treasury Fund, you can see that they were down by 20%, 25%, 23%, something in that range. So it seems like something very weird has happened here because these are supposed to be risk-free. You're supposed to be able to earn a very low yield, 1%, 2%, 3%, something like that. So how could these possibly fall by over 20% in a single year? The answer here is twofold. I'm going to give you the short answer here, and then as usual, we will go into a separate Excel file that I've created to illustrate some of these concepts, and we'll go through and illustrate a few scenarios there. But the short answer is that, first off, US Treasuries are not, in fact, risk-free. Even government bonds have some risk associated with them. Now, the typical assumption is that governments like the US and other developed countries are not going to default on their obligations. So even if their finances worsen, they will still be able to repay the existing bonds outstanding that they have. So they're assumed to be free of default risk, but it doesn't eliminate other risks from their profile. And then the second answer is that investors and traders of US Treasuries did not actually lose money unless they sold before the bonds actually matured. So going back to this chart, yes, if they happen to buy bonds right here at the start of 2022, and then they sold them at the end of 2022, they lost money. But for example, if they bought a 10-year bond at the start of 2022, and then they didn't sell here, they just held on to it until the start of 2032, 10 years later, then in theory, they should not lose money nominally on that bond. There are different types of credit risk, and the risk-free rate is a little bit of a deceptive name because it only refers to the lack of default risk. In other words, the risk that the borrower will not actually repay the loan. But there are other risks such as interest rates, currencies, and inflation, and you could lose money from any of these. And with some of these, like interest rate risk and currency risk, you could actually use them to make more money on the government bond than you would expect from the stated yield on the bond. So in this tutorial, I am going to walk you through 3 ways that you can actually lose money on supposedly safe government bonds. And I'm also going to go through a couple of ways to look at the flip side and see how you can actually earn more than the stated yield because of these additional factors. The bottom line is that the risk-free rate, the name itself, does not actually mean the security is risk-free. It just means that it doesn't have default risk, or that in theory, it doesn't have default risk. And it means that the risk-free rate is a useful comparison tool if you're looking at US Treasuries and comparing them to stocks or bonds or other types of investments, but you cannot take the name too literally. Depending on interest rates and how they change, depending on currencies and how FX rates change, and depending on inflation, you could trade government bonds and you could gain or lose very different percentages depending on these movements and also whether you're looking at it in nominal or real terms. So the plan for this tutorial is that I will go over the risk-free rate first off. Then we'll go into the interest rate risk on safe government bonds. Then we'll look at the currency risk when you buy foreign government bonds. And then we'll look at the inflation risk when central banks go crazy and print a lot of money and there's inflation in the economy due to other factors. So let's start with the risk-free rate. The most common use case here is that in valuations, you use the risk-free rate to calculate the discount rate, which is usually the cost of equity or WACC. This represents the expected or targeted annualized return that you could earn by investing in a company's stock or by investing in its entire capital structure. Now, normally the approach is that you take what you could earn in these risk-free government bonds, you add the additional return offered by the stock market, and then you multiply by a factor representing this company's volatility relative to the market as a whole. So you start with that risk-free rate, you add something called the equity risk premium, and then you multiply by beta, which represents this company's volatility relative to the market. I have the formula here. And usually for the risk-free rate, you look at the 10-year government bond yield, so the 10-year US Treasury yield, or if you're in Germany or the UK, you would look at the 10-year government bond yield for those regions. If you want to go beyond this and also calculate WACC, then you factor in the company's debt and equity and preferred stock to get an overall expected annualized return if you put money into the company's entire capital structure. I have the formula here, but essentially you take the percentage of the company's capital structure represented by each one of these and you multiply by its cost, adjusting for taxes in the case of debt, and then you add up everything here to get WACC. The risk-free rate here always sets the baseline or the anchor because all these forms of capital are riskier than government bonds, so they should have higher potential returns. If you want more on this, take a look at our separate tutorial on WACC and the WACC formula and how to calculate it quickly. We go through an example for steel dynamics, and you can see how the cost of equity is laid out and how the WACC is laid out and all that. But the bottom line is that the risk-free rate, which was very low at the time we did this, about 1.2%, sets the baseline for all these other expectations of returns by investing in this type of company. So let's go to the second topic now and talk about the interest rate risk on government bonds. And I'm going to illustrate a few ways in which you could actually lose money or potentially earn a lot more than the stated yield depending on how interest rates change. If you hold a bond, whether it's a corporate bond or a government bond until maturity, then you should earn back the full principal and you should earn interest payments along the way. But if you sell the bond before maturity, you have to accept whatever the market price is at that time. And in a lot of cases, the market price diverges quite significantly from the par value or the face value of the bond. With government bonds, the market prices change mostly based on interest rates, which are set by the central banks, and also how these interest rates affect the yields of similar bonds. So for example, if you buy a 10-year US Treasury that offers a 2% coupon rate, and then interest rates go up, and now 10-year US Treasury bonds start offering 4% interest rates, that is going to affect the price of the bond you just purchased. It's going to become less attractive because it only offers 2%, and so its market price is going to go down. Let's go into Excel and set this up, go through the mini model here and look at some examples. So here's the file. What we're assuming here is that you have bought some bonds at the end of 2020 and then you sell the bonds at some point. Now they have a maturity in 2030, so they're 10-year bonds. At the time that you purchased them, yields on 10-year US Treasuries were around 1%. You can see this if you go to Y charts and take a look at it and look at the 5-year chart. If you go all the way to the end of 2020, yields were just under 1%. If you go to the end of 2022, yields were more in the 3.5 to 4% range. I'm just going to say 3.5% here to use some easier round numbers. Now, for the exit date, we could really say anything. We could have an exit date before the bond maturity date or an exit date after the bond maturity date. If it's before the maturity date, though, what that means is that we sell before the bonds mature. If it's after the maturity date, it means that the bonds mature and then the market price is irrelevant in that case. But for now, let's just say December 31st of 2022. So we hold the bonds for 2 years. We also want to do a check here and see if we actually exit before the maturity, because in this case, then the market price will become very relevant to our calculations. So I'm going to say if the exit date is less than the bond's maturity date, meaning it's before it, I'll set this to 1, otherwise I'll say 0. So in this case, we're clearly selling before the bonds mature. You can see the cash flow profile of this bond right here. You can see we pay the $1,000 in the beginning. We're assuming it's a $1,000 bond. It has a 1% coupon rate. And what it means is that in each half-year period, we get about 5 of interest on this. So for the year as a whole, we get 10 in interest because 10 divided by 1,000 is 1%. What's missing is the future principal repayments here. So we need to fill this in by calculating the market price because we are buying this. It has a 10-year maturity, but then we're selling it after 2 years. For this market price, I'm going to go up and I'm going to see if we exit before maturity. If this is true, if this is 1, then we'll use the price function in Excel to calculate the market price at this stage. So I'll say price, and then we'll plug in the exit date because we want to calculate the price on this particular date. We'll enter the maturity date right above it because that's another required input. And then we need to enter the coupon rate on the bond, the 1%. And then we need to enter the yield or the discount rate, which is 1% we're still assuming, even though we know it has changed by the end of 2022. We'll come back to that in a little bit. Now for the next part, we have to enter the redemption percentage. This is normally a whole number out of 100. So I'll enter the 100 here. We'll assume there is no default risk because these are US Treasuries. And then we need a frequency. I'll just say 2 because that's pretty standard for bonds. So this gets us a number out of 100, but what we want to do here is actually divide this by 100 and then multiply by the bond's par value of 1,000 so that we turn this into something out of 1,000 instead of out of 100. Also, if we do not exit this first, if we actually just wait until the bond matures, we want this to reflect the $1,000 par value here instead. So I'll say bond par value right here. And now if we hold this bond and we do not sell it first, we will simply get back that full 1,000 here at the end. So now you can see what happens. Of course, what actually happened in real life is that over this time frame, from the end of 2020 to the end of 2022, yields rose from 1% to 3.5%. And what that means is that if we had held on, the market price here would have fallen quite substantially. It would have gone from 1,000 down to about 826. And this is exactly what happened. Now, the actual loss in the Vanguard chart I showed you was higher than this. It was more like 20 to 25%. That's because they probably purchased bonds on slightly different dates. They have a whole collection. It wasn't just a single bond purchased at the end of 2020. So there are reasons why it doesn't quite match. But the principle holds true that we would have been down nearly 20% if we'd done this in real life. If you want to see this on an annualized basis, you can also look at the IRR. We can use the XIRR function here because we're dealing with half-year periods. And I'll just enter the values down here, and then I'll go up and enter the dates right here. And now we can see that we are losing about 8% per year in the scenario when interest rates go from 1% to 3.5%, or yields go from 1% to 3.5%, I should say. If the opposite happens, let's say that we bought these bonds when they had a 3.5% coupon rate, and then prevailing yields on similar bonds fall because central banks now drop interest rates over time, and they go from 3.5% to 1%. Well, now we actually have a pretty substantial gain here, because what happens is that the internal rate of return is about 12% per year. The market price at the end is higher. We're up by about 20% because interest rates here have fallen substantially over time. And now this bond that we bought when it was yielding 3.5% and when it had this coupon rate is now much more attractive when similar bonds are only paying around 1% instead. So this is how you could potentially buy and sell supposedly risk-free government bonds and get actual yields, actual internal rates of return that are quite different from the stated yield on the bond. One thing I want to mention about all of this is that these points matter a lot more for long-term bonds than they do for short-term bonds. So for example, if we go back here and take a look at this, let's say that we set the bond maturity to something like 3 years. We are still down, but it's not quite a catastrophe like it was before. We're down by about 2.5% or so here if you look at the numbers. So it's not great. We still lose about 0.2% per year, but it's not really the end of the world. So this type of thing matters much more for these longer term bonds, for anything that lasts for, say, 10 years, 20 years, 30 years, much more than it does for something in the 1 year, 2 year, 6 month, even 3 year range. This is also much more of an issue if you're trading bonds rather than buying and holding them, because again, if you go in here and you say that the exit date is sometime very far into the future, say 2035. Well, in this case, you can see what happens, which is we just get back that 1,000 at the end in 2030 when this actually matures. So the fact that the market price changes in this case is completely irrelevant when the exit date is after the maturity, meaning that we do not actually sell before the maturity. Finally, this is also much more of an issue when interest rates change rapidly in a short period like they did in 2022. If they change by 1% over 5 years, you're not really going to see much of a dramatic difference in that case. But if they change by 4 or 5%, in less than a year, then you are going to see some pretty big changes. Let's now go to the second risk associated with bonds, which is currency risk. The idea here is that if you buy a foreign government's bonds, then the exchange rate between that government's currency and yours will affect your earnings. A really good recent example is the US dollar to Japanese yen pair and its crazy ride over the past few years. Now, if you haven't been following this one, the US dollar was worth around 100 Japanese yen back in 2020 and 2021, parts of 2021, but then it rose up to a much higher level. The Japanese yen fell against the dollar, and so a single dollar became worth almost 150 Japanese yen, which is an insane move for a currency in a very short period of time. Here's a chart I pulled up showing it. You can see how through most of 2020 and 2021, the US dollar was worth a little bit more than 100 Japanese yen, but then it started shooting up in 2022, and it got up to this level of almost 150 Japanese yen per dollar, and then it fell back down to more like 130 by the end of the year. If we go back to 2020 and we look at the returns over the next 2 years, but we assume that we initially had Japanese yen and we converted it into US dollars to pay for the bonds, and then we converted it back to Japanese yen, we will see some very different results here. So let's go in and look at this. We need to calculate the initial bond price in Japanese yen first. So let's go and take the 1,000 here and then multiply by the initial rate of 100, which we're assuming. And then the final bond price, we can just take the market price down here and then multiply by the 130 that we're assuming right there. And then to actually set this up, I have this separate area down here. All we're going to do is take the top part and then multiply by this initial exchange rate of 100 Japanese yen per US dollar. And then we'll do the same thing down here for the future interest payments. So we'll take this and then multiply by this 100 rate. I'll anchor this. And then we'll take the future principal repayments and multiply by this 130 rate. And I'll anchor this. I'll add all these up. And then I will copy this across. And so you can see it shown pretty dramatically there, just how much the Japanese yen fell against the dollar and just how much that benefited investors. Let's do a quick IRR calculation to see this. So we'll take all the values down here, and then we'll take all the dates right up here. And so now we can see that if you bought this bond and held it for 2 years in US dollar terms, you would have been down by 8% per year. But if you instead bought it in Japanese yen, converted it to US dollars, and then converted back at the end, you would actually be up by around 5% per year on an annualized basis. Now, of course, the opposite can also easily happen. Maybe the exchange rate falls and it becomes 80 Japanese yen per dollar. So the yen strengthens against the dollar. Now you'd be in an even worse position than the US dollar investors. You'd be down by around 18% on an annualized basis. So FX rates here can have a really big effect. And this is why you have to be so careful when you buy government bonds that are not in your own currency, because big moves like this do not always happen. But when they do happen, they can really change the returns profile of the government bond. And then for the last risk here, I want to discuss inflation. Typically in finance and in financial models and valuations, people analyze the returns and the valuations in nominal terms. So they ignore inflation. They don't attempt to adjust the amounts for the annualized inflation rate or anything like that. And when inflation is relatively low and stable, say 1 or 2% per year over a long period, and the bond's yield is 3, 4, 5%, something above the inflation rate, this is fine. Yes, it changes the results somewhat. It makes it less favorable if you factor in inflation, but when it's low and predictable, it's not really going to change the picture all that much, especially only over a few years. But in periods of higher inflation, less predictable inflation, and cases where the inflation rate actually exceeds the yield on bonds, this can make a big difference, and it can turn bonds into a completely unappealing type of investment. So let's take another look at this, and now let's factor in inflation and see just how much that affects the yields on government bonds. So let's say that the average annual inflation rate here is 5% per year. Now we could debate exactly what it is. Some people will say it's more like 10% or even 15% over the past few years. I'm not really sure, but let's just say 5% to go with a simple round number. We need to adjust the exit price here for this inflation. So let's take the bond price right here upon exit or maturity, and then let's multiply by 1 minus the 5% right here. So this will make it less valuable by 5% per year. We'll raise it to the power of the minimum between the year of the exit date over here and then the year of the maturity date right here. So whichever one comes first, we use. And then let's also subtract the year of the purchase date in the beginning. And so we have that. And so our inflation adjusted exit price is quite a bit lower, even with inflation as low as 5%, even though that's not really low. That's actually quite high if you look at inflation over the past 10, 20, or 30 years. Now we can take this and we can subtract the bond's par value right here, and we can see that the real loss here is actually quite a bit worse because we're not down 17%, we're down more like 25% once we actually factor in inflation. Now, if you also count the interest payments here, it gets to be a little bit better. So let's just go in and add these up. So now we're not quite down by 25%. It looks like we're down by more than 23% or so. I'm not factoring in inflation on these interest payments, but I think you get the idea. The bottom line is that inflation, especially when it is high and above the bond yield, is a very good way to lose money on government bonds. And this has actually happened quite a bit historically. For example, if you look at the period between about the 1940s and 1970s in the US, bond investors lost money in real terms because of the relatively higher inflation rates, especially in certain periods and certain years. So that's a little bit about why government bonds and US Treasuries are not in fact risk-free, even though the name, the risk-free rate, is based on them. We started out here by going over the risk-free rate and how it is central to valuation. It always sets the baseline for the expected returns on stocks and bonds and preferred stock. And you always look at some type of premium to this to determine the additional risk and the additional potential returns from these securities. Then we looked at the interest rate risk on safe government bonds, and I pointed out how when yields change a lot in a short period, like 2 years, when they go from even something like 1% to 3.5%, you could easily beat down a lot, especially if you sell early. Now, if you hold on to maturity, it doesn't really matter. But if you sell before then, you do have quite substantial interest rate risk. Then we went through currency risk, and I showed you how the Japanese yen investors could have potentially been up a whole lot more, even though the market value of the bond actually decreased because of rising yields, just because the yen also fell by even more against the US dollar in this period. And then we went through inflation risk, and I pointed out how even though on paper you might think that you're earning money with a government bond, if inflation is high enough, it is still a relatively unappealing investment because after inflation, you are probably still going to be down by some amount. This is a big problem when inflation is higher, when it's unpredictable, and when inflation exceeds bond yields even for short periods of time. That's about it for this lesson. Hopefully now you know a little bit more about the risk-free rate and government bonds and how to think about all these concepts in Excel. And you also have a template that you can use and play around with if you want to see more about how this works.